Melbourne property has spent years going nowhere. While Perth, Brisbane, and Adelaide surged, Melbourne stagnated, and most investors quietly gave up on it. But here is a thought that makes experienced investors lean in. The market everyone has given up on is often the market about to turn. Today we make the contrarian case for a Melbourne comeback, the case that nobody wants to believe. Let's be honest about the recent past first. For several years, Melbourne has been one of the weakest performing capital cities in Australia. Prices have been roughly flat in real terms for a long stretch, while other cities posted strong gains. There were specific reasons. Victoria introduced land tax changes that spooked many property investors. The apartment market suffered from oversupply. And population growth, while still substantial, did not translate into the price growth people expected. For investors chasing momentum, Melbourne was the obvious city to avoid, and avoid it they did. But this is exactly where the contrarian opportunity begins. In property, the best long-term returns are often made by buying quality assets in good markets when those markets are out of favour, unloved, and cheap relative to their history. Everyone wants to buy what is already booming, which is precisely why what is already booming is often expensive and late in its cycle. The unglamorous, overlooked market, the one nobody is excited about, is frequently where genuine value is hiding. Right now in Australia, that description fits Melbourne better than any other capital. So what are the deep fundamentals that still favour Melbourne, despite the years of underperformance? They are genuinely formidable. Melbourne consistently receives one of the largest shares of international migration of any Australian city. It has the country's largest international student population, which drives constant rental demand. It has the most diversified economy of any Australian capital, spread across finance, education, healthcare, manufacturing, and services, which means it does not live or die with a single industry the way a resources city does. And it is regularly ranked among the most livable cities in the world. These are not the fundamentals of a city in permanent decline. They are the fundamentals of a global city that is simply having a quiet period. Here is the key insight about value. After years of flat prices, Melbourne has become genuinely cheap relative to its own long-term trend and relative to the other capitals. Sydney is dramatically more expensive. Even Brisbane and Adelaide, after their booms, have closed much of the historic gap with Melbourne. For a buyer, this means you can acquire quality property in one of the world's great cities at a price that, in historical terms, looks like a discount. When a top-tier global city is trading at a discount to its own history, that is the kind of setup contrarian investors actively hunt for. Let's talk about where the opportunity sits within Melbourne. The most interesting value is often in the established middle-ring suburbs, the ones with good housing stock, solid transport links, and genuine character, that have been dragged down by the general market malaise rather than by any problem specific to them. These are the areas most likely to lead a recovery when sentiment turns. By contrast, the segment to remain cautious about is the oversupplied investor-grade apartment market, which has structural problems that a general market recovery may not fully fix. Now, intellectual honesty demands that we cover the risks, because the contrarian case is not guaranteed. The first risk is that Victoria's tax settings continue to deter investors. If policy remains unfriendly to property investment, it could suppress demand and keep prices flat for longer than the contrarian thesis assumes. The second risk is the apartment oversupply, which could continue to weigh on the broader market sentiment. The third risk is simply timing. A market being cheap does not mean it will rise soon. Cheap markets can stay cheap for years before they finally turn, and an investor needs the patience to wait through that period without panicking. So how should a thoughtful investor approach Melbourne? 3 principles. First, treat Melbourne as a long-term value play, not a quick flip. The thesis is that you are buying quality below its historic value and waiting for the inevitable reversion. That requires a holding horizon of many years. Second, focus on quality and scarcity. Buy established houses or well-located stock in genuinely desirable suburbs, the kind of property that always finds buyers in a recovery, rather than the oversupplied segments. Third, accept that you cannot time the bottom. If the fundamentals are sound and the price is below long-term value, the exact month the recovery begins does not matter much over a 10-year hold. The crowd has given up on Melbourne. The headlines have moved on to the booming cities. And that, paradoxically, is exactly what makes Melbourne interesting. A world-class city with formidable fundamentals, trading at a discount to its own history, while everyone looks the other way. The comeback nobody believes in is often the most rewarding one to position for early. If you found this useful, hit subscribe, because we break down a different Australian property market every few days. See you in the next one. It is useful to remember how quickly sentiment can flip in property, because the Melbourne thesis depends on exactly that. Markets do not stay unloved forever. At some point, the gap between a city's quality and its price becomes too obvious to ignore, and buyers return. When that happens, sentiment can shift surprisingly fast, and the market that everyone avoided becomes the market everyone suddenly wants. The investors who benefit most are the ones who positioned themselves while the pessimism was still thick, not the ones who waited for confirmation. Of course, nobody can predict the exact moment the mood turns. But that is precisely why the patient, contrarian approach works. You buy quality below its long-term value, and you let time, rather than perfect timing, do the work.